Hello, this is Julius from Basic Financials. A short video today on savings interest and regular savings accounts. I say it's going to be a short video, sometimes I stray off a bit, but what I'm really trying to do today is not to say that regular savings accounts are no good or anything like that, because they can be very good. I just want you to know exactly what's going on, rather than just seeing the headline rate of interest that is often put out there. And I think that's why some of the main banks and building societies will do these regular savings accounts, and I'm sure it's because you can get a good high interest rate put out there, which then draws other people into the system, into their banks, because they think, well, they're doing good rates on that, they must be doing good rates on other things, and sometimes that is the case. But so what's the little catch in the regular savings account? Now, the regular savings account differs from, say, a fixed rate bond, in that with a fixed rate bond, you'll have an amount that you've got there that you can put in. And normally, you'll just put that amount in, you won't put any more in. So it's a fixed amount that you'll stick in for a certain period. It might be 1 year, let's say, to make it consistent with the regular savers, which are normally 1 year. Now, let's say you've got £3,000 that you can invest in a fixed rate account, and let's say you've managed to find something which you probably wouldn't at the moment at 6%. Now, if you invest that £3,000 in a bond for 1 year at 6%, then let's say 5%, because that's probably more realistic. You probably could get a 5% rate at the moment. So if you invested £3,000 in a bond with 3,000 for a year at 5%, you would get interest at the end of that of £150, which is not too bad on 3,000. But what you'll often see is, with a regular saver, you might be told that you'll get let's say you probably wouldn't get a 10%, but let's say they said you get 10%, the more realistic rate that they're off. I've seen ones that are about 6.5% at the moment, but let's say 10%. They say right, well, you can we're offering a savings account that gives you 10% interest, and you think, wow, that's a lot better than that 5%, isn't it? But what they will only let you do is put in a certain amount every month. So, for example, they might say, well, you can put in a maximum of £250 a month for 1 year, and for sometimes you can withdraw that money if you want without replacing it. Often there'll be some sort of penalty if you do take it out without any notice. But let's just assume that you're just going to pay in £250 a month. You've got that to spare, and the interest rate is 10%. You won't end up with that same amount of interest at the end. Now, the reason for that is because, obviously, if you're only putting £250 a month in, for the first month, you're going to have £250 in there by the end of the month at 10% interest. By the end of the second month, you'll have £500 in there, and that's by the end of the second month with 10% interest. Now, it's only by the time you get to the final month that you will end up with £3,000 in there. So really, doesn't quite work out exactly this, but you've effectively had an average of £1,500 in there at 10%. So the equivalent, it's actually equivalent of a 5% rate of interest if you'd managed to put £3,000 all in one go straight into the account. So I hope that makes sense. So the reason is because you're building up the balance to £3,000 rather than starting off with that £3,000 balance. Now, what happens at the end of the year? Quite normally, the account, if you don't do anything, the account will be put into some sort of instant account which pays a lot less interest than that headline rate. But I'm not saying that they're not good, because if you haven't got a lump sum, but you think you probably can afford to put some away, every month, then that's a good thing to do, and it's quite nice to be able to do it monthly. It's more affordable, and at the end of that year, when the rate goes down, you can normally start a new one. So you could actually do another one, and you could actually put that £3,000 that you've managed to build up. You might be able to put it somewhere else, or you might spend it. But it's up to you. But you could probably find somewhere to put it else at a better rate. So they're not bad, but just so long as you know what you're doing. And I mean, some people will sort of find 10 different building societies and banks and do that every month, and but it's quite a lot of hassle. But I suppose if you look after the pennies, the pounds look after themselves, as they say. But anyway, it's just so that you know what's going on. Now, if you're a bit older and you're closer to retirement age, you might be asking, well, should I be putting that £250 into a regular save, or should I be putting it into my pension fund? Now, that's a very different video. And that's a very valid question as well, but maybe I'll do that. I have covered that in previous videos in some form or other. Maybe I'll do another one at some point, but yeah, if you're younger, it's definitely not a bad idea to try that. Anyway, I'm going to leave it at that before I start waffling on about other things. I hope you've found that useful, and please like and subscribe as usual. If you've got any questions, please leave them in the box below. Thanks for listening.